know your story. Some of the people I've raised the most money I know have been some of the best storytellers, frankly. They might not be the best investors, but they are great storytellers. And there's something to say about that, right? Understanding, like, you know, where and why, what makes you tick and what lights your fire, right? I think is a really important thing today, because everyone can say, hey, we've got a great industrial deal or a great office deal or a great retail center. Going back to that core thing about people investing in people, those relationships are going to drive everything.
Jonathan, great to see you. Thanks for joining me today.
Good morning, sir. How are you?
Doing great. For our folks that are joining in on LinkedIn, this is our first LinkedIn Live, or my first LinkedIn Live. I invited my good friend and industry veteran, Jonathan Glick from Incubation Capital, to spend some time with me. I thought it would be fun, given where we are in the new year, the end of January 2025, to talk about some of the trends that we're seeing in capital raising for institutional real estate and really hone in on the emerging manager category. I can't think of anybody better to opine on this topic than you, Jonathan. So thanks for joining me for this grand experiment today. Can you introduce yourself for folks who haven't had the chance to meet you? Give a little bit background on who you are and what your firm does.
The easiest way to describe our business today is we are, in effect, a vertically integrated strategic capital advisor focused on partnering with real estate entrepreneurs in growth mode. So over the last 14 years, our primary focus has been raising capital for what we call next generation real estate funds. We frankly built the business working with fund managers younger and earlier than many of our competitors, and built our business by getting those managers done. Today, our business is really all about providing a core offering around capital, people, and institutional best practices to real estate entrepreneurs. And how we do it is honestly by just getting in the trenches, taking that principle-oriented approach to everything we do. Thinking like partner to those groups around raising capital, which is our main business, as well as we also have an executive search practice. It's the people component, and then we also do some principal investing as well, which is that ventures component of partnering with people early on in their life cycle.
Awesome. So, you and I are friends. We've known each other for a long time. We can have an open conversation. One of the reasons I wanted to do this on LinkedIn is to kind of make it a little bit more casual. Look, it's crazy out there right now. You and I have been on the conference circuit this month. It's about as hard as it's ever been, in my opinion, especially in talking to capital raisers to raise money. What's going on? I mean, what are you hearing? What are you seeing with the mandates that you're in the market with? And kind of, how would you describe the current environment right now?
Where do I begin? A couple things. One, it's always been hard. It's frankly always will be hard. And I think it's only gotten harder, right? So I've been an institutional capital raiser now for 18 years, which, in dog years is what, 126 years. It's a long time. And it kind of feels like it. I would tell you, with the exception of going from the second half of 20 to the first half of 21, where a spigot opened up, if you're an emerging manager, it's frankly gotten harder and harder every year to raise capital. And the last 12, 18, 24 months has been no exception, right? The barriers to break through as an up and coming manager are harder than ever. It's all about supply and demand. And instead of it being supply and demand as it relates to real estate, it's a supply and demand game as it relates to supply of capital and supply of managers out there, and demand for that capital and where to put it, right? The real estate fund business, if you really think about it, it's evolved over the last 30 years. For some for a lot of managers out there, it's matured. For a lot of capital sources, it's matured. How people allocate to real estate and who's allocating to real estate, it's all changing. You and I talk about this all the time in terms of where the capital is coming from today, which frankly is different than it was 5-10 years ago. But as a whole, it's gotten harder and harder every year. It's not, it's no different than any other period of time. As it relates to, trends like capital, it's, we've had the last 2-3 years, right? It's been a real challenge, right? I think there are a couple of fundamental shifts that have really made it harder for existing managers. One, a re-up is no longer a re-up, right? In the sense of it used to be to get a new commitment 10 years ago, to get a new commitment from a new manager, you would have to go through a 500 question proctology exam. You'd have to get an A on the test, and then you get a commitment from that investor. Today, you need 100% on that test just to get a potential, just to be in the game for a potential commitment. And then it's not even certain. Um, for a re-up, all you used to need to do is pass that test. So, I can imagine you going in for your Series 7 and having to pass versus, get 100 on the test are two different things, right? Today, I think you need an A or an A plus to get that re-up too, right? Investors are going through that re-underwriting process for a variety of reasons, right? Performance, um, you know, uh, allocated capital shifts. LPs don't have the capital for distributions, right? That platforms are different, right? Going through generational changes, things like that. So all of those factors are making it re-up much harder. The other thing that's actually really plaguing capital flows in our business today is actually the time that it takes to get funds done, right? You've heard me say this before, but the Ricky Bobby effect, as I like to call it. You know what the Ricky Bobby effect is, correct? Um,
Sure.
if what is it?
No, go ahead.
If you're not first, you're last, right? That's greater than it's ever been, right? So, fundraisers are taking longer than ever, right? How does it impact our business? It used to be a 12, 18-month capital raise for a client. Now it's 2, 3 years easily. By the time you get your re-ups in for the first close, an 18-month raise, an extension on an extension. And that just changes how people invest, right? There are some people that will move early. They're moving early for either one or two reasons. It might be a re-up and they're loyal and they know they're coming back in anyway, or they're getting a great economic incentive to do so. But there are a lot of investors that don't invest in interim closes anymore. There definitely are some. But as a whole, it's either at the front end or the back end, and that gap is wider than ever. So if you're not first, you're last.
Where do you go to find the middle then?
As with anything else, you just have to grind it out. I mean, some people will, sometimes it's time and place. Honestly, I think it's a lot of the new capital. Where we have seen a lot of people coming in the middle is a lot of that private wealth capital that you and I talk about all the time, where a lot of the new capital opportunities are coming in, right? I think when you look at the landscape, there are a lot of investors that have been investing in institutional real estate funds for, since the opportunity fund really started developing in the late 90s, right? Your pensions, your endowments, your insurance companies, some of those are actually not as active, investing in real estate today or looking at it differently. But there's just a new class of capital in the private wealth world, right? You talk about all the time. I fully agree with you that the rise of private capital is real, right? I read a stat a year or two ago, something saying like there was 20 trillion of wealth being created or having been created in the family office world in the US since 2000. I don't know where that stat comes from, how true it is, but it makes a ton of sense, right? Um, when you look at about the proliferation of all these wealth managers out there, right? The OCIO business 10, 15 years ago, as it related to raising capital for institutional funds, was literally four people, right? And they all were platforms that basically spun out of endowments and created that outsourced CIO model. Today, there are countless numbers of OCIOs and wealth managers that my team call on that didn't exist 5 years ago, that all of a sudden are 20, 50, $100 billion wealth managers that are looking for interesting things for clients to invest in, as a differentiator, and therefore looking at new product and interesting strategies. Which so that and those groups, if they want to invest in something, they're looking at a time and place and getting it done because they're trying to serve their clients. So that, we see a lot of the interim coming from that type of investor.
Yeah, the the institutions are pretty fully allocated to real estate. I mean, some are over their allocation, some are under, but on average, and you're absolutely right. I mean, private wealth is a massive market. We have some stats, roughly 500 billion a year of annual wealth transfer from high net worth boomers to younger generations taking place, every year, and it's set to double within the next decade. And so there's just a massive amount of opportunity. I guess one of the things that's interesting about your practice is that, you spend a lot of time with emerging managers. Maybe let's start by kind of defining emerging manager and let's talk a little bit about the challenges, right? I mean, at the end of the day, I think, there's this interesting effect taking place where the capital wants to go to the barbells. On one hand, capital is flowing to the biggest of the big who will continue to get bigger. And then on the other hand, capital is flowing to these specialists, operators, niche kind of sharpshooters that can truly generate alpha. Yet, this is the narrative, and I think it is true to an extent, but I don't think it's, you tell me, you've been doing this for 18 years plus, but it seems really hard if you're an emerging manager to go from 0 to 1. How do you raise your first dollar of outside capital? How do you do it in a structure that works for institutions? So maybe let's define the category and then talk a little bit about some of the challenges that the industry is facing right now.
And I don't, and just for the record, I rarely use the term emerging managers because there's so many different definitions around it that it's very hard to truly find. That's why I've always used that term next generation, because I think about the cycles and where people are and they're, building their business. Um, there's so much in there actually, right? Like first thing I want to address is that polarization of the fund business, right? Or just the wealth, of the real estate business, right? To your point, you're either multiple billions or you're a couple hundred million, and that middle market in between, like that 500 to $1 billion size, is really undefined today, right? You're either going wait, it's like go big or go home, right? And one of the things that's actually really different, and this is why you don't see, this is one of several reasons why you don't see a lot of new managers coming out every year. There used to be a lot more. One is you have other alternatives, right? 15 years ago, even post GFC, right? If you were a niche strategy or an up and coming group, you didn't have, you could go raise a $200, $300 million fund, but it was hard to go get that money elsewhere. If you were calling on a allocator fund, even one of the big names to get a programmatic JV, it was for $50 million, right? Now that group's writing you a $200, $300 million programmatic JV. They're trying to take a stake in your business. They're doing a platform deal. We can list 25 people that are mutual friends of ours that are all doing that, where that emerging manager has lots of other alternatives today that frankly have I'd argue, a better return on effort, right? Like the capital raising is tough and building the business from scratch is tough. And, there's just more options there, right? So if you think about supply and demand of capital and maximizing your return on investment as it relates to going through that effort, right? People have other options. So that's one reason the numbers are smaller today and it's harder. The other is just frankly the fact that there's 600 managers in the room, right? Like I can imagine, I love you, but if you were one of 600 guys in a gymnasium and a girl walked in and she had to choose a guy for a snowball dance, it's more than likely you're probably not it. I know I'm definitely not it. You might have a good chance if you were in the first row, or, she saw you in your wetsuit about to go for a dip into the Pacific or something. But the reality is it's a little bit of it, it's just numbers. There's too many managers out there, right? Your average LP I talk to, and in fact, me and my team have had lots of conversations with LPs this month, and your average LP, you know, if they're doing something, many people are just doing re-ups, but if they're making commitment, it's to 0 to 1 new managers a year. And there's hundreds, if you look at Preqin, thousands, but let's go with hundreds of managers and opportunities out there. And that's why it's so hard, right? It's again, back to that supply and demand.
How do you stand out? There's a lot of investors out there who have capital. Very few of them are making new commitments every year on a relative basis. There's a very crowded group of people, full gymnasium, to use your analogy, of people who want the capital. How do you stand out? I mean, what are people looking for?
I think this has actually changed a lot over the last couple of years. Kind of goes to our point, right? So like, you asked the question earlier, like, where do we focus? Like our MO is probably like that 250 to $750 million. If you want to tighten it 3 to 6, right? $100 million institutional fund or institutionalizing fund. And we call on those investors who actually invest in them. That's our core sweet spot, right? And, we've worked with a lot of what I will, um, actually, investors and LP said this to me the other day of like what they're looking for. They're looking for new blood. So we work with a lot of the new blood, like a lot of spin outs, a lot of earlier stage groups, maybe people who are out in the institutional market for the first or second time. And that's actually what I think people are looking for today. I think one of the things that, and if you see where people have raised capital and who has raised capital, it's a little bit back into the stories, right? Um, it used to be, right? People invest in track record and strategy and process and procedure. I think over the last 5 to 10 years, especially in a post-COVID world, I think that importance of relationships of people and connectivity has just really developed, right? So, look, I have a nice little glass office. I have two things on my, written on my door right here. One of which is people invest in people, right? You've heard me say it. I've before. I think that's a real thing. That's actually why we started our executive search practice, because human capital and financial capital have the exact same underwriting, but at the end of the day, it's the story. People are investing in the story. Like, has that person, why is that person doing something different? Right. And how are they doing something different? And it might be sectors and it might be strategies, right? That's why certain sectors like iOS or data centers or, senior housing, those might be areas of interest today because there's not a lot of people doing it out there and there's not as much competition, say, versus multifamily. But the reality is that people are investing in the stories. People are making investments in the team, in the process, and it's one of the biggest things that I always find funny is, I get 20 pitch books put on my desk probably a week or my team. And of them, 90% of them talk about the strategy. We're investing in industrial, retail, office, whatever it might be. And then there's nothing about the team and the people and why they're unique. And maybe there's some bios in the back, but there's a story, right? Like you are a very we've been friends for years. You are a very interesting person and have a very interesting story, right? And you are a professional storyteller at this point, right? But the reality is that, people invest in that. Like, and to some extent, I get it, right? If you think about it, if you have 25 industrial managers to choose from, or 20, you want to invest with someone who's going to be good and know what they're doing and skilled, but it's also someone you want to go spend, you're investing in the relationship, right? So you're underwriting that relationship and it's someone who you're going to want to go to the annual meeting and see, right? So, oddly enough, like being likable and being a partner and having a mutual relationship is actually a component of it. So that people component, I think, has actually become more important than ever. And honestly, since you talk to people every day, I'm curious to hear your thoughts on that. And sometimes I feel like I'm alone in that view. So I'm curious to get your thoughts on that.
I agree with everything that you said. I'm not sure I'm a great storyteller, but except for that comment, but everything else I agree with. We all talk to a lot of people, and the one through line across all the conversations that I think we have or that I have is the importance of relationships. And it's people invest in people. You're absolutely right. It's about trust, but I think more than ever before, it's about authenticity. Um, long gone are the days where, you could sit and talk your own book and everything you do is great and everything everybody else does is crappy. Not that it was ever that way, but at the end of the day, I think what investors and consultants and others tell me that they really appreciate is having a point of view. Even if they disagree with your point of view, having a point of view and, more than just a point of view, providing something actionable, something investable, something useful, an insight, a perspective that people hadn't thought of before. I mean, candidly, that's one of the reasons why I wanted to do this. It's, how do you create new forums to share information? How do you create authenticity? This is not scripted. You and I have no idea what we're going to talk about next, but having a point of view and being out there and being willing to be wrong, I think is really important. So, I do think that people matter a lot. And I think it's a good segue, for a minute, because you are in the human capital business, you have a search practice. And I think it's interesting that you do, because people are so critical to what we're doing as an industry. I guess, from my perspective right now, I'm seeing a lot of people, very high quality people, looking to shift roles because their current roles don't have alignment. There's, not just incentive and compensation alignment is one part of it. I mean, I'm talking about cultural alignment, strategy alignment, moral and ethical alignment. So, I mean, what are you seeing right now on the people side of things as it relates to kind of the intersection of human capital and financial capital?
So almost everything on our pipeline, when we go through our weekly pipeline with my team, almost has two components of our three things. And we talk about people. If we talk about people, advisory, and ventures, like usually the conversation's around two things, right? So, um, we are going through at the end of the day, and I strongly believe this, we are going through both a major market repricing, secular shift in our industry. That's pretty obvious, right? It's taking a long time, but we are, and we're also going through a demographic shift at the same time. One that hasn't been seen since the mid '90s, right? So the one thing that I've done my entire real estate career is underwrite people who invest in real estate, whether it's as an advisor, as a principal. Prior to being a placement agent, I was doing entity level real estate investing way before people even knew what that was. And and at that time, coming at, in the mid 2000s, you just looked at the age of principals and where people were in their business. And, we analyzing all these groups, I saw a lot of people in their mid 30s get an opportunity out of the RTC. And they grew many people grew very successful businesses at that point. Right. The reason I started my business, almost 14 years ago, we're 2 weeks shy of 14 years, is here in Chicago. I started a real estate networking group. It's called Crepe. It's similar to stepping out of bounds. It was like put 50 people in a bar one night to just compare notes on the world. Hoping people show up, and fortunately people did, and I made a lot of friends out of it. And 15 years later, 60 years later, it's been great. But I took a lot of, up and coming people under, a lot of people my age who were thinking about spinning out, and talking to them about their desires. And honestly, I had two conversations. I had two back-to-back coffees this morning with two people in that exact discussion this morning of, I'm, thinking about, leaving my role, or I'm trying to think about the next steps. Do I take a job, or do I go hang a shingle and go do deals as an operating partner? And at some point, part of the reason I started my business was out of seeing the cycle then, and post GFC. Out of dislocation comes opportunity. Now's the time to take the opportunity. I was actually wrong a little bit from a demographic standpoint, because of existing players and things like that. And yes, but many successful businesses came out of that. Right. One of my first fund client was Seth Singerman, who you just had on your podcast not too long ago, and is a mutual friend. And but he was an example of that, right? We were neighbors and having coffees once a week about him starting out of his business. So it's kind of the right time, right? And but now is that opportunity, right? So now you look and say, okay, you've got a lot of platforms that have been around for a long time. These questions on generational transition plans. Yeah, look, a lot of real estate firms are not that good at that. And so people are saying, hey, we're at the bottom of the smile of the cycle. We're either coming down to the bottom or coming up from the bottom, but we know that the next 3 to 5 years is going to be the recovery in the sector. It's very hard to not believe that. So people are saying, hey, now I want to do something entrepreneurial. My opportunity cost is probably lower. Now might be the chance to do it, whether I'm forced to or not. So many times we're having conversations with groups. We'll have someone call me. This happens probably once every couple of weeks, where we have someone calling us about raising capital, but they're also need people, which is why we've also started the search business. But then the second component around it is the people calling might be a partner at the firm, and then they're looking to raise capital, but then they're also thinking, hey, we might have some reasons that there's other things going on, and can you find capital to back me? Right? I've gotten that question on more than ever today. So, and by the way, this is now is when new platforms form, right? If you go back and look through cycles, right? You talk to way more groups on a regular basis than I do. But if you look, like now is the time platforms form, especially ones that become very successful through cycles, right? So we're seeing that, and I'm having those conversations, and we have people coming to us daily on that right now. So and that's part of the cycle, right? Like people that don't have legacy issues, people with good ideas, people who are thinking creatively. And by the way, that's who's been raising money. If you look at the groups that have, it's either people who are doing something slightly different or people who have um, access to deal flow and are actually executing, right? I think one of the challenges, everyone talks about how bad it was last year. Going back to the Ricky Bobby effect earlier, one of the reasons it's been so hard for people is the fact that um, uh, if no deals are getting done, the why now question when someone's underwriting you um, is not answered, right? So the people who I know are actually raising money are people who are actually putting it out and doing something, where whether they're thinking about it differently or executing in areas others are not, but they're coming up with things that you know you know grab the attention of people. And I think we're seeing it today. Like I've had some strategies that have come up to me lately that I was like, this is really cool stuff. Like people buying very niche assets, trying to aggregate different strategies, right? Just people taking a different approach to things. That's what's going to define the start of the cycle before it becomes just more of a, alpha recovery.
Let's just get maybe a little controversial. The world doesn't, finish my sentence. The world doesn't need another.
Multifamily manager or real estate credit fund.
Why?
And by the way, this has been like this for several years, right? So just so you understand, we took out a multifamily manager, a great multifamily manager, to market in like 2018, 19. And that was the most common feedback we got from them. Like, great, we love it, young team, like totally next generation manager. But the world doesn't, we already have options, right? There's already, to your point, people in a gym. If there's 100 people to choose from, all of which are, you know, like hunks, male, 100 male models, right? you know, you know, my, my, Drew fur wearing self is not going to, be the guy who gets picked, right? Despite how hungry and passionate and gritty I am, right? So that is, I think, one of the challenges there is that there's just so many players. And also in a way, right? Because of the number of players out there, there's a lot of competition on the fund cap for the capital. There's a lot of competition on deals, right? And it's hard to differentiate. So the groups we've worked with in multifamily and continue to do so have really defined, unique stories. There's some special sauce around it, right? Like in the sense of like either where they're working, how they're doing it, might be a micro strategy. I'm a big believer for a lot of the core asset classes today. I'm a big believer of micro strategies, right? So for multifamily as an example, like regional guys are doing certain thing a certain way, right? And same thing for real estate credit funds. Like how do everyone talks about accessing deal flow and sourcing capital. Um, there are lots of great players out there. There's lots of options. And in that case, it's harder because just how people sometimes structure their vehicles. Some people have fees on invested capital. Some people don't, right? There's so many options and it's very hard to differentiate yourself, going back to what we talked about earlier.
What do we need more of?
Investors who are looking to invest in real estate and understand the cycle is more at the right place to cycle to be allocating for the next 3 to 5 years.
What do you think happens that unlocks the capital that's out there and gets it connected to the managers that can invest it over the next cycle?
I think there's a lot of things. I think there's a lot of factors that, there's just a confluence, a lot of factors that actually have to happen. And I think it's starting to. But, being realistic, the world in institutional real estate world kind of took a pause in September of 22, right? It was just after our first reel, if you recall. And I remember, you probably remember the comment too at our first emerging leader summit that, excuse me, talk about live. Sometimes you belch. The At our first summit, there, if you recall, there was someone in the room that said, "Oh, wow, if interest rates go to 4 to 5% and stay there, we're all in trouble." Right? Well, fast forward 3 years, right? Like, where are we? Right? At the beginning of last year, there was a lot of optimism, lot of optimism that, oh, things are going to come back to life in 24, right? That faucet's going to turn on. And what happened is a lot of people wanted to do things at the beginning of the year, but then, there's a big difference between want, need, and can, right? And and that's why things have been slow, and that's why fundraising as a whole has been down. It's been in pockets, obviously, but I think it's been more challenging as a whole. This year is no different. In fact, this year might be worse because what you were seeing is, what were people waiting for at the beginning of 24? People were waiting for, oh, the Feds, the second the Fed starts, dropping rates, things will be great for real estate. Interest costs of capital can come down. We'll know we'll be through the, you know, the harder times, and we can look forward. And people started transacting, right? There was volume toward the summer. People started to look to deals again. People are saying, oh, pipeline's up. And then what happened, right? Interest rates, the Fed funds rate started going down, and everyone's cost of capital seemingly went up, right? Which people said, wait, there's a disconnect. And then we go into the election, and there's definitely uncertainty of what the new the new administration brings, right? And I'm assuming, the president being a real estate guy at heart, that's probably good for our industry, but who knows, right? There's you never know what's going on in the world. No one can control macro things, right? But at the end of the day, today there's just much more uncertainty, right? And so what turns that faucet on? I think capitulation of assets, where people are actually finally seeing um, uh, real deals at basis where, like, I'm in, like, that's a joke. Like, we've seen this in office over the last 2-3 weeks, where I've seen people say, oh, it's now cheap enough, I'm starting to look, right? Um, but the reality is that once people see, like, oh, wow, I'm really getting deals at the right price, and assets are getting forced to take action, right? There's been so much can kicking in our industry for the last 3 years, right? It's been a proverbial can kicking, right? And the second that stops and people actually feel like they're starting to miss out, I think that's when, and people can actually point to, here's why you are going to get outsized returns investing in real estate right now, and it's the right time of the cycle to be investing in real estate. Until that question can be answered both on a macro and micro level, then that, I think, will turn that faucet on. And but there are things that are different now, right? I think one of the things that's different is underwriting that manager and capabilities and skill. And look, I've had, in my whole view was partnering with up and coming younger managers historically. And finally now, 14 years later, LPs are, truly telling me, like, generational transition planning and understanding what the 7 to 10 year plan of the team is, has become a very real, considerable question. It's something that's a big part of the underwriting going forward. So this is where we might have a shift of managers over the next 3 to 5 years. There was
So
a lot in there for you.
yeah, there's a lot. There's a lot, and
Where did we go?
well, look, I think you're a busy guy. A lot of people reach out to you and your team to try to get you to take on their mandates, right? If I had a nickel for every time I heard, I emailed Glick, but he didn't get back to me, I'd be very wealthy, but I don't. So people who are listening now have the benefit of hearing your perspective. You know, if you're an emerging manager or you're a manager, you're a spin out, you're looking to start your own shop, kind of what advice would you give to somebody trying to get into the business right now? I guess it's, don't be a general multifamily player. Don't be in private credit because the world doesn't need another one of those. But like real, like actionable insights. Like what should you do if you want to begin the journey of becoming, an up and coming or a next gen manager, and you want to get your attention or somebody like you's attention to help them legitimize the platform and raise money?
I wish we weren't live and I'd have a prepared answer for that. But I know I'm going to miss some things here, but a couple things. One, you know, it is time for people to grind like hell, right? Like, that grit, that passion, that drive, now is the time to make that investment, right? So seeing that and willing to do that, and that willingness to do that, right? That's the first thing you're going to need. Two is, know your story, like know what that story is. Like, where you've been, how you've got there, where you're going, right? And that's not just a critical component of like, differentiating yourself from the investment strategy. That's the same thing for search, right? Like that's how we view our search process is no different, right? You're telling the story because if you're a candidate at a company, you're underwriting that story and you're believing in that story. Otherwise, you're not taking that job. And if you're not believing that in that story as a company, you're not hiring that candidate. It's the same thing, right? But know your story. Why is it unique? And stick with it and live by it, even if it's different and everyone says no, right? A great example. This is a long-standing client relationship and friendship and mutual friend of yours, right? Is someone I met back in 2000 and probably 11 and 12. And at that point, it was literally him, his wife, and an intern at a kitchen table. But they had a very unique investment strategy in multifamily, actually, of all things. It was a 10-year underwriting for us before we actually partnered with them and we raised the fund with them. But, um, it's just sticking with the guns and getting stuff done. So we see this a lot now too. People are like, I can't get X done if I don't have the capital. Well, no matter where we are in the cycle, a good deal always has capital. It just might be a little bit harder to get, and it might be a little more expensive, right? But and know your story. Some of the people I've raised the most money I know are some of the best storytellers, frankly. They might not be the best investors, but they are great storytellers. And there's something to say about that, right? But understanding, like, where and why, what makes you tick and what lights your fire, right? I think is a really important thing today because everyone can say, hey, we've got a great industrial deal or great office deal or great retail center. But, going back to that core thing about people investing in people, right? That's what's going to drive, those relationships are going to drive everything.
If you had $150 million to allocate, you are an allocator today, where would you put it?
Evenly across all of my current client offerings. No, like seriously, it's hard to pick your favorite cousin, your favorite children. So, I think, look, we're now going, where are things actionable today, right? There are certain places like office is actually oddly starting to get interesting, right? Like at some point it's going to be cheap enough. And I think once someone figures out how to underwrite office, in a new model, like, TIs and leasing commissions will just, like they kill any office owner. You can figure out the right model, the right way to lease office space going forward. Like someone's going to make a killing in office, like, Sam Zell, like wealth creation. I don't know who and when, but that's going to happen in office. Um, I do like sectors that things are actionable, right? Like we have some of our, we do have we have a client focused on senior housing. Um, you know, um, that and we have diversified clients looking at senior housing, right? Like it's kind of a great time for that sector. The demand's there. There's lots of broken situations. And things are capitulating, right? Because they're being forced to. So anywhere where that capitulation is happening, right? So middle market deals coming from regional banks where banks have to get rid of assets and they're not widely pushing them. And you have those relationships with the banks, like great area, right? To find things because that capitulation is happening. Overall, I do like the niche sectors. They're just very durable, less players that have developed their expertise, right? The reality is, if we can go through every niche sector and we can talk to, like, if you think of, it's like that line from Coming to America. If you think of garbage, think of Akeem. Like if you think of senior housing, there's probably 3 or 4 guys or 10 guys that would list off as like, oh, like these are the guys that are, people that come in mind, right? In any sector. So the niche stuff is still, there's lots of demand for the niche product. But one specific spot, 150 million. Ask me in 6 months. Need to see more capitulation.
Too much uncertainty, too much capitulation. Well, look, I think there's a lot that we can cover, but I think, that's a great spot to end because,
I think we've bored enough people for the last 40 minutes on our
well,
live
look,
program.
the markets are clearly dynamic. I think this is a moment in time. And one of the beautiful things about this type of platform, this interactivity is, we can just go live and share our thoughts on kind of where things are today and, know that that could change next week or the week after. So, Jonathan, if people want to get a hold of you, I've already told the audience that you're not great at returning emails and phone calls to prospective clients. What's the best way for them to get your attention or the attention of your team, or learn more about
Reach
your
out to
practice?
us. I've always, yes, time is, we'll always find time at some point. Just sometimes takes a little longer to get back to people, but we're always happy to, my favorite part of my job, truly is kind of, you know, talking to people about their story. Whether it's, why they're growing people or why they're growing capital. And, we probably talk to, I don't know, as a platform, me and my team probably talk to 15, 20 GPs a week, right? On, how they're growing their business. So, reaching out to me or anyone on my team is, we usually try to, if we can get back to you, we try to do it as soon as we can. So, and worst case scenario, they can ping you, who will send me a text to get back to someone and put pressure on me.
I knew you were going to say that. Don't do that.
You've
That's a
done it
bad idea.
before,
Well,
or we'll do it
no.
again.
Joking aside, Glick, I really appreciate the time. You have a great perspective on the market. You're a wealth of information, and those that you work with are lucky to have you on their side, along with your team, of course. And until we chat again, have a great weekend.
Thanks, you too. Talk to you soon, man.